Hello and welcome to this session. This is Professor Farhat. In this session, we're going to be looking at the Health Savings Account, or HSA. Now, this topic, in a sense, it's related to medical expenses, but I would like to treat it separately because it's fairly a new concept and I want to make sure I give it enough justice. This topic is covered in an income tax course, the CPA exam regulation section, as well as the enrolled agent exam. As always, I would like to remind my viewers, and that's you, that I would like to connect with you on a personal as well as a professional level. So if you have a LinkedIn account, please connect with me. If you have a Facebook account, please like my Facebook page and connect with me on a personal level. You want to make sure you subscribe to my YouTube. This is where I house all my lectures. Like my lectures if you do like them. Share them with others, put them in playlists so others can benefit. I do also have a Twitter account and a website where I house all my courses organized by lectures. Health Savings Account. What is the idea behind Health Savings Account? Well, the idea is this. Generally speaking, health insurance is an expensive item in the US. Okay, and hopefully we all know this. If not, if you're outside the US, insurance is expensive. So what happens is this. What companies would do, they will have what we call high deductible plan. And what is a high deductible plan? Simply put, what they would say is this. We have high and we have low deductible. So you have two options. So when you sign up with your company, they would say, would you like to have a high deductible plan or a low deductible plan? What's the difference between them? Generally speaking, if you have a high deductible plan, the premium is lower. The amount you have to pay, premium is lower. So your expense is lower. When you have a low deductible, your premium is higher. How does it work? Let's assume you are a healthy individual. What you do, you would say, you know what, I'm healthy. I am not going to use my medical insurance. I'm going to have a high deductible plan because my premium is lower. What does it mean, high deductible plan? Simply put, high deductible plan means the insurance company will not kick in until you pay a certain amount of money. Simply put, for example, I'm making up this number, the first $5,000, any expense you incur, the first $5,000, you have to come up with it, okay, with the high deductible plan. So the insurance company will kick in after you incur the $5,000 and the dollar. That extra dollar that you pay, now the insurance company will cover going forward above that dollar. Low deductibility means you might have only to pay out of pocket maybe $500. After you incur $500, the insurance company will start to cover you here. But for a low deductible plan, you're going to have to pay a lot for that because the insurance company is intervening after $500 of medical expenses. Okay, so we have to keep in mind that we have a high deductible plan and a low deductible plan. Okay, and a high deductible plan means you have to pay more upfront from your pocket before the insurance company kicks in. Low deductible, you might have to pay $200 to $500, maybe $1,000, then the insurance company will kick in, and that's per year. Okay, so high deductible plan are cheaper. So what you do, if you have a high deductible plan, you will create an HSA account. What you do is this. You have your work, and what you do, you're getting paid from work. And you will tell your company, if they have a high deductible plan, I want to create something called HSA, Health Savings Account. And I want to transfer from my payment, for example, $100 a month, okay, and put it in that HCA. Now, why am I doing so? I should not have deleted this. You remember, I have to pay the first $5,000 out of pocket. When I'm paying those $5,000, I will pay the $5,000 from this account. Now, what is special about this account, Health Savings Account? The amount that I contribute to this account, it's tax deductible. So I don't pay money on that amount. So I will take money from my paycheck before I pay taxes on it, put it in that Health Savings Account. Why am I doing so? Because when I incur medical expenses in a high deductible plan, I would use this money to pay it. This way, I can save some money on my taxes. Okay, so I shelter the money to pay for my medical expenses. Okay, let's look at an example. Sanchez, who's married and has 3 dependent children, carries a high deductible medical insurance with a deductible of $4,400. So simply put, the insurance company will not kick in until Sanchez and his family incurred $4,400 in medical expenses. So what Sanchez does, establish an HCA and contribute the maximum allowable in 2018. During 2018, Sanchez family incurred medical expenses of $7,000. The high deductible covers $2,600 of the expenses, which is $7,000 minus the $4,400 deductible. Sanchez may withdraw the $4,400 from the HCA to pay for medical expenses not covered by the high deductible plan. So simply put, they incur $4,000. He got $4,400 put away in the HCA account. So HCA account covered this much. What's left is $2,600. This is covered by the insurance company. Okay, so the high deductible plan covers the remainder. Okay, first you pay out of your pocket. But Sanchez was smart, said, let me put away some money. And they put the maximum, which is $4,400. Now, what does that mean to the Sanchez bottom line? Let's assume Sanchez in the 20% tax bracket times 20%. And simply put, 4,400 times 0.2. Sanchez saved $880. So by putting away this money away in an HSA account, they saved $880 on their taxes. And this is the benefit of health savings account. So high deductible plans must meet two requirements. Okay, the annual deductible in 2018 no less than $1,350 for self-individual and $27 for family coverage. So for a plan to be considered high deductible, if you're alone, you have to come up with at least $1,350 or $2,700 for family coverage. The annual limit on total out-of-pocket expenses under the plan does not exceed $6,650 for self-employed and $13,300. So the out-of-pocket expense cannot exceed that much. Okay, those are to be considered a high deductible plan. Again, for a tax treatment and HSA contribution and distribution, HSA. First, you have to have a custodial account. What does it mean, custodial account? It means you have your work, that's where you get paid, and you have to put that money away with a custodial account, some company. Okay, so the money is transferred to that company, and you will pay when you have your medical expenses. You'll pay from this account to the hospital. Okay, what are the rules? Here are the rules. Contribution made by the taxpayer to an HSA account are deductible from gross income to arrive at AGI. So this money is deducted for AGI, which is good. Excellent. This is what we want. We want the money deducted for AGI. Thus, the taxpayer does not need to itemize to get this deduction. So you'll get this deduction without itemizing. That's why I kept it separate from the medical expenses on Schedule A, which is great. For AGI is great. So you'll take the money, put it away. What happens when this money is sitting in your account? Well, it's going to earn interest. Earnings on HSA are not subject to taxation unless distributed, in which case taxability depends on how the funds is used. So if you earned any interest, it's not deductible. It's not taxable as long as you use it for medical, for the purpose of paying your high deductible policy. Distribution from HSA are excluded from gross income if they are used to pay for medical expenses not covered by high deductible policy. So if you use the money for that purpose, then you are covered. You don't have to worry about taxes. Distribution that are not used to pay for medical expenses are included in gross income. So simply put, if you put that money away and you use it for something else, it's your money, but if you use it for something else, you are subject to an additional 20% penalty. It's not only you pay taxes on it, you pay a 20% penalty. Subject if made before age 65, death or disability. Obviously, if you are before age 65, you passed away or you're not disabled. Any distribution made by the reason of death or disability and distribution made after the HSA beneficiary becomes eligible for Medicare are taxed but not penalized. So if, for the reason of death, disability, or you reach the Medicare, you would still pay taxes on the money because it was tax-free going into your account. It was tax-free. It went into your account tax-free, but the penalty is waived under those circumstances. Okay, so how much can you deduct? Well, how much can you contribute? In other words, if you are self only, like by yourself, like single, you can deduct you can contribute $3,450. If it's a family, it's $6,900. I believe the double. Okay, $6,900 for 2018. If you are over 55 and 55 years old, you can deduct an additional $1,000. Okay, again, no deduction is allowed once you are eligible for Medicare. Okay, let's take a look at an example. Leo, age 45, who is married and self-employed, carries a high deductible medical insurance policy with family coverage with an annual deductible of $4,000. So it is high deductible. In addition, he has established an HSA. How much can he contribute to his HSA? $6,000. If you have any questions about this topic, please email me. If you're studying for your CPA exam, as always, study hard. If you happen to visit my website for additional lectures, please consider donating. Good luck.